This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Vic Lakhwara of Green Cow Venture Capital. Vic, thank you for joining us.
Hi, Hall. Thanks for having me on. Despite the backdrop of coronavirus, I'm happy to be here.
Hope you're staying safe there. So what was your background before joining Green Cow?
Well, how much time do you have? My journey to building this fund with Maggie Springer really didn't follow the typical investment banking to MBA to VC route. In fact, after graduating college, I joined a small boutique consulting firm, which provided executive education for Fortune 500, Global 200 companies, and venture-backed startups. There, I got a pretty strong fundamental understanding on how companies of all sizes build customer-focused products and services. Eventually, I moved back up to the Bay Area with an eye on getting back into the startup ecosystem. That's when I joined Wilson Sonsini as a marketing analyst. For all those listeners who don't know Wilson Sonsini, they're sort of the globally renowned law firm in the technology and life sciences sector. And they were some of the earliest rainmakers in Silicon Valley. So less than 2 years as a marketing analyst at Wilson Sonsini, I was asked to be the first hire of a corporate venture capital fund by an attorney at Wilson Sonsini, who was enlisted by his client to build this $100 million fund called SK Telecom Ventures. And while I was working at SKTVC, it was an amazing, fantastic experience, but also very much trial by fire as my first experience in venture. We focused on digital media, internet, and mobile investments. I was involved in basically every aspect of the deal cycle, from sourcing to investment memo writing to providing support to our portfolio companies after investment. We actually made 16 investments and had an impressive 8 exits at the time, 5 in less than 4.5 years that I was at the fund. Afterwards, I rejoined Wilson Sonsini, this time as the head of business development and partnerships for the startups and venture capital practice at the firm. This is where I kind of worked closely with hundreds of our startup clients, forged strong relationships with the investor community, facilitated deal flow amongst the startups and investors, and built curriculum and programming with our attorneys for universities and accelerators across the country. I always sort of had that itch to get back into venture. And it was really my wife, Laura, and my business partner, Maggie, that encouraged me to scratch that itch. So for that, I'm forever grateful. And that brings us to Green Cow Venture Capital.
Great. So that's a good history as to what led you to start work in the VC world. But what's your advice for people who want to be a VC? What would you tell them to do first before they go down the path you've done?
Yeah, so I was born and raised in Silicon Valley in the 80s, and my dad was a serial entrepreneur, built the first spreadsheet software. So I was actually around the startup ecosystem growing up and became very enamored with it at a very early age. And I don't think most people have that experience or have that access at an early age. And for me, my epiphany and what drove me to get into venture capital was when I realized that I fundamentally was better at helping guide the builders from a practical and business perspective rather than building and coding on my own. And that passion, which is manifested in all those different ways throughout my career, really pushed me to get into VC. And fundamentally, if you don't have that passion, don't get into VC, because being a VC is not playing golf and going to fun parties at all. It's incredibly hard and not for everybody. But for those of us that are like me, that are really passionate about working with entrepreneurs, my advice would be kind of fourfold. Number one, read everything tech related and get a handle on market landscapes, because that will help you adopt a very thoughtful and deliberate way of evaluating startups. Number two, find an area where you can be an indispensable mentor to founders and to your investor peers, whether it's a niche or an area of growth or a technology, et cetera. Try and get really good at that one thing and be indispensable. Number three would be to be proactive I think there are so many organizations and funds out there that promote internships and jobs in venture capital that if you really want to be a part of it, you can be. And there are ways to get involved. And number four, it's really just to hustle as much as your founders do. I think if we're learning anything in these hard times is that there's always opportunities for those that do hustle.
Well, that's good advice for people out there who want to be in the VC world. I know quite a few people who do. And so that's good coaching there. So let's talk about the state of investing in venture capital. How is the industry evolving? What do you see happening these days? And of course, we have the new COVID-19 that's coming up and want to hear your thoughts on that as well.
Yeah. So, wow, that's a really important question, which could probably be the topic for our whole conversation. But for now, I'll focus on sort of two trends that are really shaping the VC industry. The first trend is really access, right? There are more investors, types of investors, and investment business models, and better access to funding methods than ever before for entrepreneurs. The second piece is that entrepreneur access to technology platforms to build solutions to problems has never been easier. And this has a number of ramifications, right? On one hand, entrepreneurs can build cheaply and they can fail or find success pretty fast. More people can become entrepreneurs. More people can gain access to capital, to build these solutions to problems. But similarly, you're also creating a lot more noise as you have more entrepreneurs. On the other hand, VCs fundamentally have to be more disciplined in our approach to investing and cutting through that noise and evaluating startups. The other piece is that there's greater competition now at every stage for great deals. So VCs like ourselves and like the founders that we invest in have to provide value beyond the check in order to stand out amongst our peers. The second kind of key trend is that markets are cyclical. So until recently, we were 11 years into the largest economic expansion in our country's history. So Maggie and I, thinking through this, we knew that the likelihood that all of our portfolio companies would face a time of growth or potential acquisition during an economic recession was very high. So building a recession-resilient portfolio was something that Maggie and I thought long and hard about and is really a pillar for what we've built over the last 2 years and for our investment thesis as a whole. Now, obviously, as you mentioned, these conditions have totally been accelerated by coronavirus. And this tragic pandemic has created the new norms of shelter-in-place living and has created this cloud of either a recession or depression overhead. And a lot of people are obviously, and businesses are suffering, in particular, the brick and mortar SMBs. And I think from a VC's perspective, a lot of our startups' business models are going to be tested right now, right? At a time where cash is king, if people haven't forecasted accordingly, there's going to be a lot of technology startups that don't make it. Maggie and I have been preaching basics of business fundamentals and cash burn reduction to weather this period to all of our portfolio companies. But at the same time, I think VCs are actively coming together to continue to support their portfolio companies and fund the development of new companies, particularly as it pertains to new use cases generated by social distancing, supply chain changes, and delivery of goods and services. I think GCVC has just been ahead of this trend a little bit, as building a recession-resilient portfolio was something we adopted very early on in our investment thesis. And we've focused on startups addressing the need to haves and not the nice to haves. Those that are leveraging technologies like artificial intelligence, machine learning, robotics to solve global market problems around inefficiency and scarcity. I think that's one thing you'll see across the board in our portfolio of companies. They're really well positioned to thrive in an economic downturn. In fact, as you mentioned in a previous podcast, in these hard times, they've really accelerated the adoption of technology and therefore created conditions for our portfolio companies to kind of position themselves for success. If you don't mind, I'll give you two examples.
Sure.
So one portfolio company, String, is tackling the way that companies are interacting via consumers with text. In a similar way that we're seeing boom of tools like Slack and Zoom that provide alternatives to shelter-in-place rules, String is basically created and enabled enterprises to adhere to regulatory standards of communicating with their consumers and their customers, while also communicating in ways fundamental to their practices. In the past few weeks, String has actually helped Meals on Wheels to coordinate additional volunteer and donor support to help feed the most vulnerable among us through this crisis and beyond. And they've helped equally a company that's founded a virtual school for kids during this crisis in order to help manage the way lead inquiries from parents that are seeking alternative programs during quarantine are found. Another such portfolio company is Cloud Admin. So Cloud Admin is tackling this fundamental problem around an inefficiency around cloud capital expenditure. Enterprises are massively overspending on cloud infrastructure, and this problem is only getting bigger as setup is more complex and enterprises adopt hybrid and multi-cloud strategies. Now, on top of that, coronavirus has exacerbated this issue. And in fact, Microsoft reports that Azure has a 775% increase in traffic that they're going to see. And that's going to lead to even more activity for a company like Cloud Admin, which has created the next gen cloud management tool to reduce cloud costs by up to 70%.
Those are great portfolios that you have there and a great model itself. What's the role of revenue when you look at companies? How much does that play into your decision versus not play into it?
The decision to invest or not?
Right.
Yeah, so we're fundamentally at this early seed stage of investing. And we know that a company's business model may pivot multiple times before they even hit Series A. We like to position ourselves at that inflection point where a company is starting to show real traction after proving out product market fit. And revenue is just one of those metrics that we look at. But traction and usage statistics are sometimes just as fundamental and necessary.
Great. So what are the challenges in starting a fund like this, and what's been the experience so far?
So again, starting a fund on your own is very difficult, right? Fundraising is fundamentally not just for startups, but for us as investors as well, is a difficult road to pave. And at the same time, it's really exciting and worthwhile journey to take if you're willing to go through the pain points. I think finding those investors or limited partners that with whom our investment thesis resonates has been the most gratifying piece of this process, right? And fundamentally, Maggie and I have put a lot of our own hard work and capital into building this fund. And so creating an investment thesis that we are very disciplined about enforcing and evaluating startups by has been a real joy to do. And it's exciting to see these companies now that, we've spent all this time building what we're calling a recession resilient portfolio. Now they're actually facing an economic downturn, and seeing them be in a position to thrive is really good to see, kind of validation of our investment thesis.
That's great. So you're a micro VC, and we see a number of those coming onto the marketplace today. Why is that? Why do we see so many micro VCs coming up, and what do you think the role they have in the VC community is there for them?
Well, it's a good thing and it's a bad thing all at the same time. I think one of the fundamental problems is, and tried to address this earlier, is that I think that there's a lot of noise that you have to cut through, and it's very popular and it's kind of in vogue to be a venture capitalist nowadays. But not everyone fundamentally has experience or is cut out to be a venture capitalist. And so I think that it's fundamentally there are two dynamics that are kind of going on, right? There's the fact that, okay, it's popular to be a VC. on one end and we're jumping into it. And then there are those that have a very methodical, thoughtful approach to the markets. And if you're in that latter camp, then the hope is that as a micro VC, you bring that thoughtful approach to evaluating startups and into whatever your investment thesis might be, right? And I think that's the most important piece about it.
It certainly gives the opportunity to bring new investment theses to the table, and it sounds like you have a pretty unique one as well. And so what else would you like to talk about as far as how Green Cow fits into this landscape?
Well, I think it's interesting. I talk to a lot of people about Green Cow Venture Capital and how we're trying to manage profits with purpose at the fund. I think fundamentally what's most exciting about this space is that we get a chance to fund startups that are taking it upon themselves to solve global market problems. And again, that's a really exciting time because when I first left venture and was first in venture at SKTVC, a lot of what founders were doing and what was hot was really around the app economy, and it was about consumption and eyeballs. And so it's fundamentally really refreshing to be at the stage where we can, as a micro VC, really provide this capital lifeline to founders that are taking it upon themselves to solve the big problems and have and generate great impact, not only from a revenue perspective, but on societal infrastructure as a whole.
Well, that's much needed service for sure. In the last few minutes that we have here, what else should we cover that we haven't?
Sure. So, honestly, I think with coronavirus, I'd really be remiss if I didn't say how important it is for all of us to practice social distancing to stem the proliferation of coronavirus, and that we support those on the front line of treating those infected. And that includes demanding and providing help to those doctors and nurses and hospitals to get them the essential supplies they need to do their job more effectively and safely. I think it's important that we sort of demand our elected officials to support the Medical Supply Chain Act. And while the government kind of continues to flounder here, we should really support services that are popping up that either support local businesses or directly influence the distribution of critical goods to these people on the front line.
Right. And one last question before we close out today. You see a lot of these changes like move to telehealth and move to e-commerce and remote work. How much do you think we're going to go back to the old way versus we're just going to continue in the new way going forward? In other words, a lot of people are expecting the stock market to snap back in the next week and we'd be back to the same number of airline flights, same number of face-to-face meetings. But as longer this goes on, it seems like it won't be going back to the old levels. But what's your take on it?
I think that whether this is a recession or a depression is yet to be seen, right, in terms of the length of this crisis. But I do believe that market dynamics are going to dictate that it's not going to be a long-lasting depression, right? That we might snap out of it, certainly not within a week or two. But I do think that there are going to be new norms that are established because of coronavirus, and it's going to have much longer lasting influence on the way that we work and that we live. And those companies that understand and that adapt to these new use cases are going to be those that succeed.
Very good. So how best for listeners to get back in touch with you?
Yeah, so you can check us out on the web at greencow.vc, on Twitter at greencowvc, and LinkedIn. And of course, feel free to email me at vic@greencow.vc. That's VIK@greencow.vc.
Great. We'll add those to the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
All right. Thank you so much, all. Be safe.
You too.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org.
Hall Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.